Welcome to Exit Algorithms, the podcast where we decode what it really takes to unlock growth, streamline operations, and prepare your business for a high-value exit. I'm your host, Pete Vera, and today I'm excited to bring on Dr. Adam Link as my guest. He's a certified financial planner with a doctorate in computer science, former senior engineering manager at Coinbase, and the founder of Fireweed Capital. Yeah, I have a list of things impressive about your resume here. But Adam, thank you so much for joining us today.
Thanks for having me. Looking forward to being here.
Yeah, can you start off and share for listeners your background? I read, you exited three companies, and the fourth one went the IPO route. Um, I'd love to, and you're now just investing. You have a big portfolio. I'd love to hear how you got started in business and yeah, it's your journey.
Yeah, no, that's a great question. Yeah, so I guess we'll kind of go back to college, right? So I got my undergrad in finance, and like you'd mentioned, I've got a doctorate in computer science. I learned best through formal education, so I basically just like picked up certifications and degrees along the way, but really got my start in finance. I happen to like capital markets finance. So there's really two routes that you can go in finance. One is corporate finance, where you're basically working inside of a company, working in net present value analysis and stuff like that. And then capital markets finance, which is much more stocks and bonds and what happens, every day on Wall Street. So I like the capital markets side. That actually led me into a brief stint in investment banking.
Hmm.
For those of you who don't know what investment banking is, if you are scaling a company and readying it for sale, investment bankers are who you're going to talk to most likely. Investment bankers are basically real estate agents, but for businesses. So you sell a business you don't own to a buyer, and you make a commission off of it, much the same way a real estate agent sells a house. So yeah, I worked in investment banking for a little bit and actually left investment banking for my first startup that we ended up selling. My first time at the exit table was kind of luckily there that I had a background in investment banking. I had seen some deals go through, been a part of a few deal teams. So I knew enough to sit on the other side of an exit table and kind of negotiate some terms. Oh, and then that was really my foray into tech. We sold the company. I got kind of brought on in the acquiring company, and they wanted to build a mobile app kind of lab around myself and some other companies that they were acquiring. Moved into tech at that point, and then spent, oh gosh, probably more than a decade in tech. And that was in
Hmm.
tech between founding companies and selling them, eventually working at Coinbase during the IPO. Spent a lot of time in crypto, about 9 years in crypto as well. So yeah, really, did a lot of tech, and kind of throughout all of that was always the person that ended up answering finance questions. With my background in capital markets finance, I was always the person that ended up talking, well, here's what you should do with retirement. Here's how you should think about, stocks and bonds and investments. A couple of years ago, I decided, I should get paid for this. And so I went and became a licensed financial advisor and started just advising, friends and family members to begin with. And then that really turned into what Fireweed Capital is today, which is a financial advisory firm focused on tech individuals and tech families, basically like myself.
Yeah, gotcha. Yeah, makes perfect sense. You've been on
Yeah,
all sides of the transaction there. Fun
exactly. Yep.
in-house experience. Yeah, I'd love to dive in a little bit on the specifics of your exits. Yeah, did you learn anything? Is there anything you would have done different? I imagine the second and third were probably a little more smooth.
Yes. Oh man. Yeah. Every exit you learn a little bit more. So the first exit that we did was a mobile app that my friend and I had built, and we had a company reach out to us and say, we want to acquire the app, bring you guys on, and like I said, kind of build a mobile app studio around us. And that was my first exit where I really got to look at the deal terms and negotiate them, right? So I had seen previous exits, in the hundreds of millions of dollars range. And there's earnout clauses and there's lawyers that get involved and there's this whole official process you do. And so I kind of came to it with, that view of like, well, there's going to be a whole bunch of clauses. And really there wasn't. It was a pretty simple term sheet. And what the acquiring company was looking for really was, could we prove out the value in the mobile app, and really show that there is a future business there, right? And what we ended up doing was basically trying to meet the metrics that they put in front of us and meet them in any way possible. And so fun I guess lesson learned in that one was, we spent a lot of time and effort to try to meet the metrics through any means possible. And what we found out after meeting the metrics through any means possible was what we had interpreted the agreement to mean, which was certain numbers had to be hit to get an additional earnout. The acquiring company had a very different view, which was certain numbers had to be hit a certain way to show sustainability of the business.
Mm.
And it was a very interesting kind of second phase of the negotiation, because what they basically said is, look, you guys, you took any means possible to meet those numbers. And what we wanted was to prove out the viability of the long-term value that we were going to acquire. And so it basically became this mismatch between, us being short-term incentivized to kind of get these numbers up to what they wanted to see and them having a long-term view. And that's really where, I guess for me, I learned he who has the gold makes the rules. That's the golden rule of business. And what we basically ended up with from the acquiring company was a decision on, well, do you fight for this earnout, which was a portion of money, but not a ton, or do you stick around and kind of continue to build their company? And my founder and I chose, or I should say my co-founder and I chose different routes. He left, I stayed. He basically said, I want that earnout money, and they didn't agree to the terms that we had on paper. And I said, I want the earnout money too, but I also get their point of view, and I'd rather stick around and grow and build this new company, right? So that was kind of one of the first things I learned, right? Is that like what you have written down, what you end up with when the check has hit the bank are two different things, right?
Wow.
Fun couple weeks of very heated phone calls back and forth, right?
Oh my gosh.
Yeah. So that was really the first thing. Make sure everyone at the table understands the goal you're aiming for, right? And so, some subsequent exits, I should say, that there were earnouts. And basically, same thing, hit certain numbers, get to certain metrics to show viability and, get an additional payout. And I went in with my eyes open the next couple of times because I basically got to say, hey, look, there was one that I knew there was an earnout clause in there, and I knew it was going to be unlikely we were going to hit it. And so when we sold that company, I basically said, I'm going to take that value of the contract and remove that in my mental math, and I'm going to basically negotiate as if I'm not going to get that earnout. And I was right. We didn't get that earnout. The targets were too aggressive, right? And so we basically said, okay, well let's negotiate everything else but that earnout and just kind of let them have that, right? Give them a win, and we'll try to negotiate everything else, right? So we get the best possible deal we can, knowing that we're probably not going to hit the earnout, and hey, it's gravy if we do.
Gotcha. Yeah, that's awesome. You learned from the first time.
Exactly. Yep.
Yeah. Did you have a business broker or investment bank helping you in the sale process?
I actually didn't. Yeah, none of the exits we used a investment bank for that. I have worked with investment banks. There was a capital raise we did for another business. That business, like any good entrepreneur, there's always more failures than successes. So that particular business ended up failing. But yeah, we were using an investment banker to try to raise some debt, basically to expand the business. And just it was around like the 2014 era, and just the macroeconomic cycle was not good. And so we did not get anyone really biting to give us debt, which was a unique and interesting experience. Like again, working for investment banks, there's a very deep bench of folks that bank knows and they talk to. And so being on the other side as a company, then having an investment bank go out to the market and come back with no one wants what you're selling. That was like, oh, so you can fail. You can fail to raise capital, right? And there's some entrepreneurs out there that say, well, yeah, of course you can fail to raise capital. I failed to raise capital, right? But for me, that was really the first time that like we went out there to raise, and we had an A team, and nobody wanted it. So it's kind of like, well, if nobody wants to give us debt to expand the company, we might as well wrap it up. So we did. We just wrapped up that company and said, well, it's not worth really pursuing that concept any further. Just take a loss.
Gotcha. Yeah, know when to pivot.
Yep, know when to pivot, and know when to call your CPA and say, I'm going to have a write down this year, so get ready. Yeah, get ready for the when you have a write off of all your equity, and then and this also goes into other lessons. Work with your CPA, because on those years you got that write off, maybe you sell some capital gains in your portfolio. That's the year to do it.
Yeah, that's a good tip too. Yeah, words of wisdom there. Watch out for the earnout. That's really unfortunate. Like, kind of weaseled you out of some money there. I've heard that happen too. Like, that's not the first time I've heard that. I'm sure you've talked to people that have that's happened to also. But I don't know any way to around that. I mean, besides like if you have a lawyer maybe that's like really knows M&A and make sure that contract's ironclad.
Yeah, exactly. Well, and one of the interesting things that that taught me too, because I actually did call up a lawyer and I said, hey, there's this earnout clause here, and is it worth suing? And the number he gave me, it was a number that still sticks in my mind. And this might surprise a lot of people in small business, but the number really to get a lawyer involved in any sort of a lawsuit over a contract is about 50 grand. And that may even be higher now because that number is years old now. But basically, anything below about 50 grand, it's not really worth even spinning up a lawyer. It's all just blustering threats back and forth, right? And so, as a small business, if you're really like more the mom and pop side, right? Something to think about, right? That, if you got a customer that owes you 50 grand, you're right on the cusp of whether it makes sense to sue or not, right? Or if you're owed money, or conversely, if you owe someone money, 50 grand is kind of that point at which, might make sense to either settle out of court or just call their bluff, right? Because they're probably
Mm.
not going to try to enforce. So it was a very interesting discussion to have with the lawyer. And basically, he said, look, there's going to be a cost for us to do this, and there's going to be a time. And if you're going to spend 50 grand getting this, is that worth what you're going to get, right? Knowing that there's a chance you may not even get anything, right? And so that's also been something that's kind of stuck with me as I talk to a lot of smaller startups too. Smaller startups that are in their first round of funding or kind of pre-seed. 50 grand is kind of the point of no return, right? And so like
Mm.
if all you got to do is sue for 50 to $100,000, it's not even worth suing. Just take the loss and move on, right? And that's for a lot of people like a non-performance for a key hire, or some sort of a salesperson exiting and taking a customer, something like that. Like there's a lot of things that fall in that 50 to $100,000 range for small businesses.
Yeah, that makes sense. I love that kind of 50,000 as a benchmark. That's good advice. Yeah, and I know you're an expert, of course, in investing. I saw you push back against index funds, and I'm curious why, you know, why the hate and what would you propose instead?
Yes. So I will say that in the US, the financial advisor curriculum that everyone learns in order to get licensed has a very strong emphasis on what we call the efficient market hypothesis, which essentially says that at a certain point, all the information that can be known in the market is known. And so therefore, thinking you have an edge is pointless. And basically, the only carve out that really the curriculum makes is insider information. Right? So if you know something that nobody else does because you work at the company and you trade on that, well, yes, you can get an edge. But then you go to jail because that's illegal. Right? Now, what we actually know through academic research is that the efficient market hypothesis is not actually true. There's a number of factors out there that cause publicly traded stocks to move certain directions and continue to move up or down. Like momentum trading is one well-known, academically studied, and persistent factor. So right away, efficient market hypothesis is not true. And what index funds really rely on is the fact that, look, the market's eventually going to discover the right price. And so if we just hold everything, we can't pick winners and losers. If we just hold everything, we pick the winners and the losers. Stocks over the long term go up, and therefore stocks go up over the long term. We can't pick winners and losers. Markets are efficient. We might as well just buy everything for the lowest cost possible.
Mm.
And that is a very good thesis over the course of 30 to 40 years, assuming you never look at your portfolio. And where it begins to break down is in real life. When the market drops 30% and you look at your portfolio and you realize you have $100,000, $500,000 in losses, the human brain starts to freak out. Or let's say it works great over 30 years, but you're 4 years from retirement and you just happen to be in the wrong 4 years of that 30-year cycle, right? Now you're retiring, losing money in your portfolio. And so what sounds good on paper in passively investing in index funds actually breaks down when you meets real life. And so that's why at Fireweed Capital, we don't do passive investing. We take an actively managed portfolio and we take a stance on the markets, and we try to basically navigate through the markets and have an eye towards stopping losses rather than winning every single upside. And what we found is that actually gels with the way humans think. Humans hate losing. They hate losing almost as much, or I think it's like twice as much as they love winning, right? And so if you stop a loss, that's incredibly important. And it also helps people stick to the plan they've made. So that's kind of why I was a fan of index funds early on in my career until I saw that first drawdown and I sold. And I thought, okay, I know everything that I know, and I've been trained in this, I've got a degree, and yet I still felt the pressure to sell during a downturn and the pressure to do something. And I did something. And if I know all this and I've got all this training, what chance do regular investors have who don't have all this training? So yeah, we really built Fireweed Capital around that premise of like behavioral finance is a thing, and you have to meet humans where they are. And sitting out a 30% decline and saying just hold on, not really financial advice people can stick to.
Yeah, oh, definitely. That's a risk a lot of people don't talk about. I grew up on, like the simple path to wealth, Jack Bogle, Vanguard's philosophy of just broad-based index funds and just hold on. Um, yeah, you don't think about what if the market tanks close to your retirement, right? Yeah, that's really interesting. So for business owners who have most of their wealth tied up in the business, what would you say is the best strategy to diversify their portfolio?
Yes. So as a business owner, you've got a lot of your net worth tied up in a business, and you've got your income tied up in that same business. And you've got your liabilities tied up in that same business. And you are exposed to the cyclicality and market cycles of your business. So the last thing you want to do is have your investments also in that same boat where your investments are going to go up and down the same way your business does, right? So what you really have to look at, and this is something that I've thought about as well in my own life, I take risks in a certain area of my balance sheet. So for me, I've worked in startups, small businesses. I've kind of had more of a volatile career, right? So I've taken a lot of risks with my job, which means my portfolio is less risky, right? I generally
Mm.
tend to steer a little bit more conservative. So I trade futures in my portfolio, right? I don't, YOLO all my money on Bitcoin when it's down, right? Because I'm not trying to turn my portfolio into a 100x bet, right? I'm trying to do that with my day job. Same thing with a
Mm.
business owner, right? You shouldn't be looking at your investment portfolio and saying, I need to take 1 million and turn it into 1 billion in my investment portfolio. So I'm going to take risks like that, right? What you should be thinking about is, where am I going to take a risk as a business owner? I should be taking my risk on my business, right? Betting on myself and my ability to grow my business, and whether my business, through bad storms and stuff like that. And my portfolio should then be playing defense. Because what happens
Mm.
during the downturn in your business is you need to tap into your personal net worth and your personal balance sheet to keep your business afloat. More often than not, any bank you're going to talk to as a small business owner or as a business owner is going to look at your own balance sheet for some sort of personal guarantee for debt or some sort of financial strength. And I've had this happen multiple times, being a guarantor on multi-million-dollar loans, where the bank basically says, look, we get we're probably not going to come at you for X millions of dollars, but somebody has to sign on the dotted line that says we can. And so as a business owner, right, if you're going into buy big real estate or you're financing a large purchase for machinery, there's a high chance that you're going to have to personally sign on the dotted line on that loan. Basically tells the bank, look, I get it. You're probably not coming after me for a $2 million building because you're probably going to sell the building. But on the off chance that we sell it for 1.8 million and I still owe $200,000 in the loan, I agree you can come at me. And so when is your business going to be in a situation where they're going to enact that clause, right? It's when your market is down, when your customers aren't paying, when your industry is struggling. And so at that point in time, you need to have a strong personal balance sheet. So if the bank
Mm.
comes to you and says, we need $200,000, you're not turning around to your own portfolio that has gone from 1 million to say 600,000. And now the bank says, and we want $200,000 out of that, right? Because now you're looking at a down portfolio and the bank's going to come and force a judgment against you. And that's just a really scary place to be, right? You're watching your business implode, you're watching your portfolio implode, you're watching basically everything implode, right? And where you want to be is, yeah, my business is imploding, but I've got a leg to stand on my portfolio. It may not be as much as I want, but it's something that I can lean back on, right? And I can take a little bit of time and kind of recoup and say, what am I going to do my next thing? Now that my business has hit a rough patch.
Mm. Yeah, I love that perspective. Just like first principles kind of thinking, just risk analysis. Are you on the you want to be on the offense or defense, and plan your portfolio accordingly. It's
Exactly.
very
You know,
intuitive. Yeah.
yeah, and not every asset has to be, offense at the same time. Same thing. If you've got a business that you've built as a passive income business, and you basically say, look, this is never going to grow beyond X amount of size, maybe now your business becomes the defensive portfolio, and you start looking at your investment portfolio as the more aggressive offense, right? I see people do that with real estate a lot, right? Where if you get your real estate in a good position, you're cash flowing heavily, you're not expanding your real estate empire, your debt's well covered. Now start going, maybe doing venture capital investing out of your portfolio,
Mm.
right? Like you've got a solid income stream off of real estate now, right? So where are you going to get your next million? It's probably not in real estate then, right?
Yeah. Oh, makes perfect sense. And you mentioned crypto earlier. I wanted to touch on that, seeing as you're an expert very much in the space. What are your thoughts on crypto? Like, do you have a lot of your clients invest in certain coins or just Bitcoin or what's your strategy? Yeah.
Yeah, so we don't generally recommend investments in cryptocurrency for our clients. The way that we manage portfolios is we manage broad base on an index industry basis. So we look at basically broad based industries. We don't take individual company bets, and that's kind of why we also don't take individual crypto coin bets. There's just risk inherent to an individual asset that is not there when you look at the whole sector, right? Um, the easiest way of explaining this is if you invest in a meme coin and the meme coin goes to zero, doesn't mean that crypto is bad. It meant the meme coin was bad, right?
Yeah.
And so we try to avoid that type of risk in our clients' portfolios. Now, when I look at crypto overall, if we were talking, 5 years ago, crypto was an attractive place to be where you could turn $10 into 1,000. You could turn 10,000 into 100, right? You could turn a small amount of money into a fairly large life-changing amount of money. I don't think we're there anymore in crypto. I think
Mm.
the days of $10 in Bitcoin and you wake up and you're worth $10 million, like those days existed. They're not the days we live in anymore. That was 2015, 2016. ICO craze of 2017 where we minted millionaires out of the Ethereum stack. I think there's enough money in crypto now that crypto is going to continue to stay around. But I also look now at the real world tokenization, the real world asset push. I think that's where I get the most excited about crypto today. So it's
Mm.
not necessarily an individual meme coin or what can this coin particularly do, but it's the idea of can you take a real world asset and bring in hundreds of thousands of people, right? Or if you're a small business, tens to hundreds of people, right? Because I really look at that and I say, that's the type of thing that's going to democratize access to real estate. For a small
Mm.
business, I think real world asset tokenization is going to be great for mom and pop shops. Already, we have this idea of crowdfunding money, right? Where you can sell equity in your company to people who are customers and who are strong advocates. I think real world tokenization is going to remove some of that friction, and it will allow customers of your business to own a part of your business, right? And be in the room where decisions are made type of thing, become very strong brand advocates for a very small amount of money. And I think as a
Mm.
business owner, that's probably the best possible outcome. I think we're still a bit of ways from that because there's a bunch of paperwork that has to catch up still. You owe K1s to partners and stuff like that, right? Or 1099s. So there's a little bit of IRS paperwork we've got to figure out yet. But I think the future, as a business owner, you can imagine taking your top 10 to 100 customers and bringing them on and making them owners. That is customer retention, right? They're going to
Mm.
stick with you because they're a part of your company now. And they're going to be brand advocates because they're a part of your company, right? Like you've now taken the best possible solution and sold it to them for maybe $100 to $1,000 or $10,000, right? And like they're
Yeah.
now paying their customer acquisition costs, right? Like that's really cool. So that's what gets me
Yeah.
excited about the crypto side.
Yeah, definitely. I love your outlook on that. It's funny how policy lags so far behind technology. I
Yes.
was just talking to someone about autonomous vehicles, and it's the same thing. We're probably still 40 years off before we can get the policy. The technology's already there, but the policy changes that have to be go through all of the hoops just take forever.
Yes, exactly. I was reading the same thing around the autonomous cabs that they're trying to put out now. Like one of the biggest reasons why we will probably not have fully autonomous cars is the regulations require a steering wheel. And
Mhm.
like getting the regulations changed to make a steering wheel optional in the right way is like this insurmountable thing. Same thing with like flying taxis. I was reading about that. Like
Mhm.
the reason we don't have a huge flying taxi fleet is regulations. Basically, it says where you can and cannot land airplanes and helicopters. And like that's why we don't have flying taxis. We have the technology. We just don't have the rules for can you fly a taxi 10 feet above a street, right? And like in the absence of rules saying you can, people aren't going to build flying taxis.
Yeah, wow, that's a great example. Yeah, speaking of technology, AI, I know you're deeply entrenched in that as well. You even got your master's, right, in computer, or no, your PhD in computer science. I'm curious, from your perspective, how is AI impacting your industry and where do you see it going?
Yes. So in the industry of financial advising, AI, and I actually gave a talk about this to an industry association about 4 months ago now. And that talk's already out of date because at the time I said AI is coming to help us construct portfolios better. And you can pick stocks and you can say, here's my client, here's the risk tolerance. Can you give me a stock portfolio or a bond portfolio or a combination of investments that match the risk tolerance? And at that time, it was really cool because I just done that. I just built this huge dividend paying portfolio, like with multiple optimizers and just stuff that you could only get with like professional trading software. And I did it all like
Mm.
in a weekend with Chat GPT at the time. So that was really cool. Now, fast forward about 4 months, and we are at a point in time where I think AI has drastically increased its utility almost every week. Even 3 weeks ago, I don't think we were in the position that we are today. So when I look at the way AI is changing the financial advising industry, for me, on client calls, I have Claude open and I'm typing into Claude when a customer asks, a question that I'm like, I have a 90% probability of my answer being right. I'll just type in like a couple things I'm just foggy about, esoteric rules and stuff like that, and just be like, hit enter. And as they're telling you about their situation, I'll have an answer coming back and I'll have it citing, regulation and rules and examples and case studies. And so by the time the client finishes their question, I've already basically read a case study of something similar, and now I've got a grounding in where my answer is going to go, right? And so, like real time getting clarification on questions is one thing that I've been using AI for. It used to be,
Mm.
financial advisors were trained, don't make it up, just say I don't know, and that builds client trust. And that's true. And I think a better answer now is I know most of this, but give me a second because I've got a few questions. Type, type, type. Now I've got the answer. So let's move forward, right? It's almost like the way that we used Google a couple of years ago in conversations, where it was like, I'm going to Google this in the conversation to get the additional context I lack, right? Now we have AI to do that. So that's
Yeah.
that's pretty cool, right? I I don't think AI is coming for all of our jobs yet. I think there's still a human touch that's required. But AI is getting pretty good at mimicking humans and reading emotions, right? It's going to be an interesting, very fun future, But I do know that in my practice, for instance, and I've told the story, I think only one or two other times to some folks, but I was quoted an onboarding fee for a marketing company, and they
Mm.
were going to charge me a few $1,000s to build out some marketing deliverables and then run a Facebook ad campaign for me. And I looked at a few $1,000s for an onboarding fee. I looked at the cost of tokens using Opus 4.6. And in the course of a weekend, I built software that built their entire onboarding funnel and ran Facebook ads for me for about $300. And I used them
Wow.
as a marketing company. It was just one of those like, now again, I've got a computer science background, so I knew what I was doing. But like, I was like, okay, they wanted a few $1,000s for a few $100. I replicated their software as a service platform,
Wow.
and now I run it. So why would I pay them? What value do
Yeah.
they bring?
Yeah. Wow. Causing major disruption in some industries already. But
Yes,
I agree. I think you said this earlier, but like there's still going to be a degree of human interaction that's required. I think that's probably going to take generations to overcome, right? To be okay with talking to someone on the phone, it's a robot, an AI tool, but they give you the right information. I think especially the, baby boomer generation, they might not ever get there. Yeah, humans still necessary to, well, fact check sometimes and keep it in the rails and interface with the client at a bare minimum, right?
exactly. Yeah, hallucinations are a thing, right? And what I'm finding now is having one AI agent that does work is good. but having a fleet of AI agents that each do specialized work is really what the future is, right? So you've got your AI agent doing marketing, and then you have an AI agent that is checking for compliance with marketing rules for your industry. And then you have an AI agent that is checking your pictures to make sure the pictures pass your quality bar. And then you have a copywriter AI agent that checks the copy that you created so it doesn't sound like AI, right? And then you have an agent that's overseeing all four of those agents to make sure they're all playing together nicely, right? And so like what was one agent, like just go to Chat GPT and ask it, to write you a Facebook ad. What it's going to be is like 5 or 6 different agents all coordinating to work together. But when you think about that, like if you have a marketing team, right, you got a team, or even if you have one marketing person, they're putting on a different hat, right? And so that is kind of how we're building agents. The one thing I would say though, since you talk to a lot of small business owners, is if you are in the SaaS, software as a service business right now, any upfront costs that you put on your customers, a savvy customer is looking at that in the amount of tokens they can buy on an AI model to replicate your entire platform. And it's not hard, right? You got screenshots of your SaaS software, you got a website. You tell me it's going to be $10,000 to onboard me. I will take your website, I will send it over to Claude, and I will say, can you spec out what this product is? Tell me how long it's going to take to build, and give me an approximate token cost. And it will be less than $10,000. So just something to think about if you're in the SaaS industry right now, that like there is a time, and I think it's very fast approaching, where you are going to be weighed against the cost of tokens to provide your entire platform. So there you go. There's something, and that is a few weeks old now. That is like a few weeks ago, I was not thinking like that. Now I am, right? So that was 14 days of change.
Yeah. Wow. It is so crazy how quickly it's propelling. It's like every couple of weeks, right? We get something new from AI, some new capability. Exciting where to go, a little terrifying probably if you're a SaaS company owner.
Yes, exactly, right? Like you've got to come up with a reason why your platform exists and why you charge what you do charge. Yeah, because otherwise a competent computer science engineer with AI can really crank this out. So also conversely, if you're working with computer science folks in your business right now and you're not using AI, you're being left in the dust. Every one of your tech folks should be using AI to crank out code. Like I said, my background is in tech and I've done a lot of tech startups, right? So I've got a lot of unique insight into that. Man, it is the best time to be a software developer. And if you've got a team of software devs under you, you should be expecting the world of them right now because they can deliver it.
Yeah, incredible. Yeah, you got to ride the wave, right? When the internet was the same way. People were resistant to using it at first, and then it became an absolute necessity. I don't think I'm alone in thinking that AI is probably going to be that disruptive also, right?
Yes, I think that I remember having to dial up onto the internet, right? And you knew when you were on the internet versus off. And over the course of a few years, it became, well, everyone's got a second phone line, or you had, a dedicated DSL. And now you don't even think about the internet being a thing that could be off, right? It's like a catastrophe when it is, right? I think AI is going to be like, right? But you also then think about what the internet has enabled, like, well, this podcast being one of the things that like we're nowhere near each other and we're talking, and yet this seems totally normal, right? So like, what is the next 10 to 20 years of AI going to look like, right?
Yeah, exciting. And no one knows.
Exactly. It's gonna be an exciting future though. It'll be a very different future.
Yeah, no, a lot to look forward to. Well, Adam, it's been an incredible conversation. Thank you so much for all the insights. I always leave listeners with, one practical tip. If you could give one practical tip to business owners that want to build wealth that survives their exit, what would it be?
Yes. So a lot of people will spend, 5 to 10 years building a business, and they'll spend about 5 minutes planning the exit. And all of a sudden you wake up one morning with a very large bank account. And then you figure out what you do with your life. What I would suggest business owners do is spend a quarter or two thinking about what your life will look like before the exit, and start talking to advisors, financial advisors, legal advisors before you get there. Because a lot of the time you can set up structures to preserve generational wealth. And after the fact, you end up owing taxes instead. So if you spend just a little bit of time before the exit, planning for that exit, you will be able to hold a lot more generational wealth for your family and your descendants.
Well said. Thank you. Yeah, a couple of years at least planning in advance, I think is appropriate.
Exactly. Yep. Plan early, plan often.
Yeah, absolutely. Well, where can it's been an incredible conversation. Where can listeners find you easiest?
Yeah, so you can go to fireweedcapital.com. That's our website. You can just fill out the contact us form that goes right to me. Otherwise, you can email me directly, adam@fireweedcapital.com. And I look forward to answering any financial questions you got.
Awesome. I'll leave that in the show notes. Thanks for your time, Adam.
Awesome. Thanks so much, Pete. Have a great one.